Hey everyone, James O'Reilly here to give you a spring market update. I'm going to jump straight into this. We're going to get started with the Australian domestic share market. So one of the things we've observed since April of last year is really strong growth in the share market. Indeed, excluding COVID-19 and obviously the significant fall and then the peg back, we've experienced pretty consistent growth for about 36 months now. We have the share market pretty close to all-time highs. We actually did hit our all-time high in August of this year, and you notice this graph is a year-to-date performance from January 1. You notice here is that we had our peak in early August, and since then we've been in a very volatile holding pattern. As I've shared with a lot of our investors, but something that is that we're really focusing on quite a bit at the moment is that whenever markets are at either all-time highs or all-time lows, we tend to see a lot more volatility. The market wobbles a lot more when it's at all-time highs, and the effect of that is that when we look at really wobbly periods, whether they're weeks or days, high volatility is the norm in this environment. It is part of being invested. What we're focusing and dialing in on here are falls of more than 5%, concentrated falls of more than 5%. And what you'll observe is that we're just getting a much higher concentration of these at the moment. That is to be expected. Now, if the market continues to go on its strong positive journey, we're going to see more and more volatility in the future. And the reason for that is because the higher the market is, the more uncertainty there is as to whether or not that pricing is correct. And so the detractors and the people that are selling down in the market are going to sell more aggressively. People are going to be a little bit more jumpy. There are some people that are going to be just taking profit off the table. So on the balance, again, you're going to see more volatility in the markets, and that's certainly something that we're watching pretty closely. If we move across to the domestic property market, it is still going very strongly. These are the September results that September just passed. Across the board, we've seen very strong growth. Growth has come off the boil slightly. The peak growth that we had was in March, April of this year. We have seen that curb a little bit, and frankly, I'm very pleased with that in the sense that we really did have what I'd consider to be a really unsustainable level of property growth at that point. Nevertheless, we are seeing very strong growth in all of the capital cities, or certainly on the eastern side, and this is expected to continue in the coming months, and in reality, the coming years at this rate. Why? Well, the obvious reason is very simply because cash is so cheap at the moment. So it's not so much that the quality of the assets are becoming better, it's more so that the likely returns that we're going to get from any of your investments are higher as a function of the fact that the cost to invest in that particular investment is lower. And so ultimately, for any investor, the goal is to utilize whatever money you have or that you can gain access to get the highest rate of return possible. And so if your lending base is very low, well, that means that your margins become bigger. Now, equally, if investment markets become more expensive, that reduces your margins. But what we're observing is both of those negating one another, and we end up with a situation where it is still quite attractive to invest even when markets are at high levels. So we have property market at all-time highs, we have equity markets very closely at all-time highs, but still we are seeing value in the markets largely because cash is so cheap. It's also expected that cash is going to continue to be cheap for some time. Almost all of the rhetoric from the Reserve Bank is that we're going to be late 2023, 2024 at a minimum before we start to see rates increase. Although I do know that we are starting to see some of the big four banks, I think at last count, 3 of the big four banks have now actually increased their 2, 3, 4, 5 year fixed rates. And that's indicative of their anticipation of that turning around and these interest rates here starting to go up back to long-term averages. So in summary, there are some really strong tailwinds that we are seeing in the market right now. The most obvious one, of course, being that access to cheap cash. And it's expected that even in the event that there are some interest rate hikes in the medium term, it's expected over the medium to long term, we're going to remain in that low interest rate environment. Separately to that, we have a really healthy level of household savings at the moment. Household savings went down quite consistently from about 2012 through to 2020. Following COVID, a lot of Australians, that was the moment for them to start saving money and putting money in the bank and trying to protect for that rainy day. We have noticed that ratio start to come down, but nevertheless, there has been a pretty healthy spike in household savings. And that does buffer most both investors and just people in general from higher interest rates and things in the economy that are going to be unfavourable. And the last bit here is that we're in the phase of exiting COVID now, of course. We're not too far from being 80% double vaccinated across the country. The rhetoric here is that the country's going to open up again and we're going to have all of those freedoms. That is very likely to result in essentially more economic activity across the board. Some of those healthy household savings are very likely to get deployed toward businesses and toward just generally fueling economic growth, travel and the like. And that is typically very good for the economy as a whole. There are some headwinds at play too. There are three significant ones that we think are of note. The first one is not just for our country, but across the globe. Management of sovereign debt. Most countries have taken on significantly more debt throughout COVID-19, and the effect of that is that needs to be managed more effectively. We note that if we go back a decade, many of you might recall the European debt crisis, and following the GFC, we had PIGS, Portugal, Ireland, Greece and Spain, and huge concerns over how they would meet their debts. And luckily whilst that didn't really hammer markets, it certainly wobbled markets enormously for about 12 to 18 months. So it goes to show that when those risks, even if they don't materialise, when those risks present themselves, it absolutely has an effect on markets. Separately to that, we are seeing more and more concerns come out of China in terms of their property market. China has had enormous growth internally, and one of the reasons for that is so many people have moved from rural to middle class over the last 50 years. I was reading the other day that I think in 2000, 36% of Chinese people were urbanized, and that increased to 62% in 2020. That is absolutely massive shift in urbanisation, and part of that, of course, has been a lot of infrastructure. It's been a lot of property. It's been a lot of high rises, and the effect of that is that from a property market perspective and a property development perspective, some of these companies have just become absolute behemoths. One of them is Evergrande, and by all accounts, it looks like they're very likely to default on their debts. And because they are one of the biggest developers, the flow-on of that here is that it's very likely to be affecting a lot of other developers. Now, if we were to see a massive property crash in China, make no mistake, it absolutely would affect the global economy in a really significant way. And one of the challenges that we have here is that you don't get a lot of visibility in terms of what's actually happening in China at a federal level. And so the issue we have, we can rely on some of the data that's released, but there's always some question marks around the validity of that data and if the full picture is getting released. And the last thing here is around green pressure. At the moment, in a political sense, we are seeing a really high level of pressure that's coming from the pending climate summit that's in Glasgow. There's rising political factions, particularly in the Liberal Party. There are some strong concerns that they are really going to have to sharpen their climate policy if they have any hope of winning the next election. And indeed, we're starting to see some of, if you saw this in Times Square, we're starting to see some global advertising that's really making Australia the butt of these jokes around climate change in general. This is a risk for portfolios, for a lot of portfolios, and the reason that it is because the average Australian's portfolio does have exposure to investments and to equities that pollute heavily, or that are heavily into mining and these sorts of things. And the risk that exists here is that if there are to be knee-jerk policy changes, that may very well have sharp effects on specific stocks and specific funds that have higher exposure to these sorts of assets. So if this is something that does concern you as a client, then please get in touch with us. We've got a lot of our clients in the throes of transitioning across into what we would consider to be green portfolios. It's something that we absolutely love doing. If it's something that you have an interest in, then please don't be afraid to reach out and we can have a chat about what that might look like. Thank you so much, everyone. If you've got any questions about that, then feel free to get in touch. Look forward to chatting to you all soon. Bye.